Hi, Kelly. Great hearing from you yesterday. I appreciate you reaching out, and I would love the opportunity to help you put together refinance. I've run some numbers and just kind of put together a couple of different options and wanted to give you a quick presentation on what that would look like. I'll go fast. I know you know what you're looking at here, but I just wanted to do a side-by-side comparison of a few different options. 30-year fix at 90% and how to handle the mortgage insurance, and then a 30-year fix at 80% loan to value, assuming maybe the appraisal will come in more like that 740, 750, and then like a 20-year and a 25-year. So let me just jump right into it, and then let me know if you have any questions. So first off here, 30-year fix, 90% loan to value with monthly mortgage insurance. So basically with this, you'd be trading off the interest-only payment on the current line of credit, the current second, to have one loan, all paying down principal, and then not having to have that balloon payment or pay extra each month. So basically, the one loan, 90% with monthly MI, that would be 4% on a 30-year fixed with no points, no origination, no discount. Principal and interest 2807. The monthly MI is 279. Taxes 502, and then estimating homeowners or hazard insurance about $66 a month. That total payment 3655. Again, so that's no origination, no discount, title escrow appraisal, third-party cost. The bank does a small processing fee. Total closing cost right about 3124, and then prepaid items. So 6 months taxes, 6 months of insurance to jumpstart your escrow account. And then of course you get reimbursed from your current escrow account after closing. So taxes and insurance are kind of a wash because you pay those anyway. So the way that would break down, so 588 loan amount, and that's just basically what you currently owe between the first and the second, based on the numbers that we talked about. Closing costs, prepaids, and that would have about 7,000 cash to close. And I structured it this way, just keeping the loan amount the same. So depending on what the appraisal came in at, we could roll some costs into the new loan, knowing you're going to get reimbursed from your current escrow account. You're going to have that 1 month with no payment. So you could either do the full cash to close or no cash to close, or any kind of combination, or splitting the difference depending on the appraised value. But just for easy comparison and to see if anything makes sense, I just wanted to keep the loan amount the same as what your current payouts would be. So the second option here is a 30-year fixed, 90% loan to value, and this is with prepaid mortgage insurance. So you're paying upfront as a fee. It's a percentage based on the loan to value. I'm assuming excellent credit. So 90% loan to value, single upfront MI. So once you pay it, you're done. You don't have any monthly obligation, so that's going to give you a lower monthly payment. So that's 28, so it's still 4%, 30-year fixed at 90% LTV. The mortgage payment would be 2807, principal and interest plus the taxes and the insurance. And so there's no monthly MI on this one, so that's 3376 a month. Closing costs are all pretty much the same. The only difference being the upfront MI. It's 1.67% of the loan amount at 90%, which is 9820. That's paid as a fee. And then same prepaids, everything is the same except for the upfront MI. So that's 17,000 cash to close. And again, you can roll some of that into the loan if that was an option that you wanted to go with. And then if everything works out and the appraisal comes in higher, you're at 80% loan to value, whether you want to pay down a little bit of principal or the appraisal comes in like 735 is about what you need to be at for the 588. Slightly better rate, not much difference, but 3.875, no points. 2764 principal and interest, taxes 502, $66 a month for insurance still, and that's 3,333. Closing costs are all the same, so there's no MI on this one, of course, because you're at 80% LTV, and same cash to close. So the 588, closing costs, prepaids, and cash to close. So those are all 30-year fixed, no point options. The other one to take a look at here would be to do a 25-year fixed, a 20-year fixed. Those are both at 90%, and I just kept the monthly. The numbers would be the same if you want to do the single up front as it was on the initial scenario at 30-year fixed, and then a 25-year with upfront MI. So 4% on a 25-year, really the only difference, still got the MI, is 39.51 for the 5-year shorter amortization. Same closing cost and same cash to close. And then just as a comparison here, 20-year fixed, So there's really no rate break on the 20 or the 25. Same interest rate, you're just amortizing over fewer years, so higher monthly payment. More principal, of course, goes directly towards the, or more of your payment goes directly towards principal with these two options. So 25-year, 39.51. 20-year is 44.11. Still with the monthly MI, and that'll eventually drop off. So once you get to the 78% loan to value, you have to have it for a minimum of 2 years. But whether it's principal reduction or market appreciation, once you have the MI for 2 years, you can challenge to get that removed. It might take an appraisal, depending on what the markets are doing and what you've paid principal down to. But that's not a forever thing. That's a couple of years for the mortgage insurance on both the 30-year or the 20 or 25 years. So any of those options with the monthly MI, that'll eventually go away once there's a little bit more equity built up in the home. So 20-year, 90% with the monthly, same closing costs, all that. Really just wanted to show you the payment difference there. So $4,400 a month on the 20-year. And then just one more comparison here, 25-year, and this is with the upfront. So same rate, getting rid of the monthly MI. So $36.72 on the 25-year. Still have the $9,800 and the $17 cash to close. The only thing to remember on the upfront is once you pay it, it's gone, so you can't get it back. It's non-refundable. So I mean, just kind of have to run the math on paying the upfront and the break-even point on the on the monthly. So basically 35 months, so 3 years, and anything longer than 3 years, and the single upfront makes sense versus longer than that, and then the monthly would be the way to go. So just that's your break-even point is 3 years on prepaying upfront versus the monthly. So those are the options that I've put together. If you see something else that, or if you have something else that you'd like to see, let me know. I'd be happy to run some other scenarios. And of course, markets are fluctuating, so it'd be great to get an application in, and if we can catch a little dip in rates, that'd be great. But otherwise, the market's been pretty volatile, and this is where we're at today. I just wanted to share these numbers and see what you think. Give me a call. I'm at 425-293-5371. Talk to you soon. Thanks.